now joins us on the phone line for more details. Jonathan, good afternoon. So, what's your gut feeling? Do you think Greece will be bailed out over this weekend, or at least some attempts will be made towards that, or is the saga going to linger on for much longer?
I think that's the $64 million question. I think, basically, as we all know, there's no easy choices. It's either a bailout or a walkout of the Eurozone. And really, from our perspective, our sort of core view remains that some sort of deal will probably likely be done, which will ultimately kick the can down the road again, which probably then means that the Greece problem doesn't go away, doesn't get dealt with, and probably will come back in a couple of years' time to haunt us again. So basically our view remains that we do think a deal is likely. Of course, we all know with Greek politics and, of course, all the politics in the other Eurozone member states, it won't be an easy deal to get through. But we're still fairly optimistic that some sort of, the likelihood is a deal will be done.
Okay, that's an optimistic view, Jonathan. But what if, if Greece and its banks go bust on Monday and there's no deal that is likely, then what do you think the repercussions would be on global equities?
I think there's a lot of, to an extent, there's a fair amount of complacency in global equity markets. Yes, we all know Greece is a fairly small proportion of the global economy. But central banks, banking systems have had many years to think and plan for this event. So I think the impact will probably be more from a sentiment one than a sort of a lockdown in the global financial system, because I would hope that central banks actually have planned for this, and I would certainly imagine they certainly have. It could perversely be fairly bullish for risk assets, because I guess it will be interesting to see what would be the impact on the Fed and their sort of decision-making process about when to raise U.S. rates. Perhaps this could push that decision back a little bit.
Okay, Jonathan, we're seeing quite a bit of buoyancy in the European markets right now, even in the euro. Do you think if as you said, if a bailout is reached, do you see further gains in equity markets and in currency markets?
Yeah, I think European assets have been quite brutally sold down over the last couple of months. In particular, European assets do look like reasonably good value here, and therefore, if you do believe some sort of deal is likely, then European assets look quite attractive. The dollar's obviously had a little bit of a run more recently, but obviously I think that it is fair to say the euro does look quite oversold, and if a deal is done, then short term you could see further gains in the euro.
Okay, let's talk about the markets that you track very closely, Jonathan, because I remember when a lot of funds in the month of May were rapidly selling Indian equities and buying China, Ashburton was doing exactly the opposite. And I think that worked in your favor because the Indian markets have recovered since then. What in your view is, how one should approach India now? And what about the chaos that we saw in China? How did you deal with that?
Yeah, we're a couple of weeks too early, but it looks okay, and we still do have Chinese exposure, but mainly focused in Hong Kong, and we sort of totally exited the A-share market some time back. Obviously the China side really has been gathering all the headlines. We've been doing a lot of work internally about the implications of the recent fall in the stock market there. And any implications across the broader macro outlook for China and obviously emerging markets and the global economy. I think for us, the China story is the big one. It's much more important than what's going on in Greece, to be quite frank. And there is some, I guess, what we're not comfortable with is some of the reaction from Chinese regulators and the government. Especially with regards to investors and being forced back into the market and et cetera, et cetera. I think that's a negative development. You don't want, we want to see free markets and individuals and corporations, to be able to invest freely in and out of markets as opposed to being, forced to do something. So from that perspective, there is some panicked policy responses going on within China at the moment, aimed at the stock market, which isn't great. So the likelihood, to our view, of China going into MSCI seems to have diminished a little bit more. That obviously certainly will have helped. The last few weeks of what's been happening in China certainly improves the relative attractiveness of India. It's been a very stable sort of oasis of calm as such, in compared to what's been going on in the China-related stock universes. And obviously, within India itself, I don't know if obviously you're well aware of the developments of the monsoon. So that aside, we're not too concerned with that here. But that aside, we think things in India are going along pretty much to plan. Of course, earnings still have to catch up, but that's another story.
Okay. Of course, Jonathan, for India, we have had a flat year so far. The market hasn't moved one bit, not even 1% point to point. Do you think we could have some more months of this consolidation over the next few months and maybe ending the year a bit flat or in the negative territory?
Our view is probably the gains that we're likely to see for this calendar year would be back-ended, so we probably fourth quarter. I think there's very little expectation of a decent earnings. The quarterly earnings that will come through now are likely to be pretty dismal, as well. Not quite so dismal as the last quarterly reporting, but not great. But we think that what's the potential upside to this market? I would agree with you. We're not looking for anything to go on too dramatic at the moment. It's just too much risk. Too much risk events externally for India to be able to go on a sort of an extended bull run here. But I guess you could argue there's very little built into market expectations for GST. Yes, land reform looks a bit more difficult, but certainly on the GST front, the market certainly isn't pricing in a 2016 start to that, and that could potentially surprise on the upside if we get some developments there.
Jonathan, I think the market liked what you just said about 5 or 10 minutes back, especially on Greece, because there's been a big surge now that you're seeing. And really, if you take a look at the European markets as well, they are now trading with quite a bit of euphoria. The euro should come up for you. All of a sudden, there's a big surge taking place over there as well. So clearly, the market wants to go into this event with long positions on you.
Indeed, and Jonathan was making this point about the relative attractiveness of the Indian markets because of what's happening in China. I think that point is well taken by the market as well. Jonathan, coming back to the Indian markets, Ashburton has been a long-time investor in India. What are the pockets that continue to look attractive now from a long-term viewpoint?
Yeah, I think that's a good question. So there's some stocks which have certainly got derated in the last couple of months over overseas issues. You could highlight, for example, Tata Motors. That's had a pretty brutal derating over Chinese concerns with obviously their new factory they've set up there and obviously demand within China. So it's an existing holding of ours. It has been brutally derated. I think you could certainly argue that particular counter in comparison to some of the German automakers looks very attractive here. IT also, again, that sector after the last quarterly numbers that we've seen, which were pretty disappointing, that's a sector where I think you can see a bit of value beginning to emerge as well. There's pockets here and there. I guess some of the more better run companies that have high ROEs and growth rates haven't really derated at all. It has been more externally focused or in some areas where we're seeing still high levels of stress within India.
Your point is taken well on Tata Motors, Jonathan. What about something like an ICICI Bank, for example, which has also seen quite a bit of derating, not as much as Tata Motors, but would you be a buyer there?
I would utterly agree with you on ICICI. It certainly looks the downside seems to have been rather overstated in comparison to some of its other private sector peers. I guess that's predominantly over NPL concerns. Obviously, from the corporate side in particular. Yes, we like the look of ICICI here, and it is one of our holdings, and we have been slowly adding to that position in the last few weeks.
All right, so slowly adding into the ICICI Bank stock. You just mentioned briefly that there is value in the IT space. We heard from, one of the big IT players, TCS, earlier in the day. The growth has not been that great for them this quarter, but they're hoping that their increased presence in the digital space will be the growth triggers from here on. From the top tier IT companies, what do you like now?
Yeah, I think that you're right there, and I think it's a space that a lot of the big IT players are certainly focusing on, this whole digital sort of opportunity. Currently, we haven't held TCS for some time. We still like the look of what's going on at Infosys, so we're very comfortable. That's our biggest position within our fund as it stands today. We've ridden a bit of pain in Tech Mahindra as well, but we see a bit of value in that counter after the recent falls there.
All right, so those are a couple of other stocks, Infosys and Tech Mahindra. Jonathan, we'll have to leave it at that. Thank you so much for giving us your views.